Now, this may bring to your mind the question, should I also have invested in the equity markets? Unfortunately, of course, for many of us, this does come in as a hindsight. And also the second question, how can I invest in the Indian equity markets? I'm just a regular retail investor going about doing a job which may be completely unrelated to investing, or I may possibly be, practicing a profession, again, completely unrelated to investing. Do I have the wherewithal, the resources I need to invest in the US equity markets? Well, I have with me a platform that provides the US equity markets right to your mobile phone. Joining me today on the show is Viram Shah of Vested Finance. Viram, thank you so much for joining us today on the Money Show. To start off with, just tell us, is it possible for a regular Indian retail investor who perhaps has a few mutual funds, maybe a few stocks here and there in the equity markets, to actually be able to directly buy shares in the United States, like shares of, let's say, Facebook or shares of an Amazon?
Yeah, thanks a lot for having me here. And it definitely is possible for somebody to open a brokerage account in the US and to buy shares directly by the companies that they use on a daily basis and become investors in them. And what we really believe that international or geographic diversification, as in investing into international markets, is very much a need more than a choice for Indian investors. And why we believe that is, if you just look at it purely from a diversification standpoint, there are four main pillars of diversification. So there is one which is asset-based diversification. So say, for example, you're investing some of your money in real estate, you're investing in gold, you're investing in equities, you're investing in bonds. That's one. The second then is industry-based diversification. So you want some of your money in the financial services sector, you want some of your money in technology. The third is time-based. So SIPs have actually made that very popular and very good in India, where you invest your money at different points in time, so you don't invest all your money in one go. And the fourth pillar, that is geographic diversification. And so that is the one that has largely been missing in almost all our portfolios. And that is the one that we strongly believe should be added. And so now, during these tough times, during COVID, while people are at home and in the lockdown, during the lockdown, they have gotten a chance to see exactly how different markets are performing and how they're not related to each other. For example, how the NASDAQ actually has performed really well over the last few weeks and months versus Indian markets that might not have done as well. So if they would have invested some of their money in the international markets, their portfolios might have looked better today. And they move away from what we call is a single country and single currency risk.
Yeah, I think it's that's one characteristic that Viram has got spot on. We often talk about diversification. We say don't put everything in equities, put a little in debt, put a little in gold, put in real estate. That's asset classes, but we also forget about geographies. So many other markets as well apart from India that where one can invest. But like I said, Viram, for a regular retail investor, sometimes being able to extend your knowledge to Indian stocks is difficult in itself. So US stocks can all the more be very difficult. So Viram, how can one essentially get the wherewithal of knowing how to invest in US equity markets? Are there any resources available? What would you recommend they start off with if they as well want that geographical diversification, which you pointed out is so important?
Yeah, there are multiple ways to do it. Essentially, because the US markets are so deep and they're so large, there's a lot of resources available. I think for somebody new who is wanting to get started and with smaller amounts of money, there are a couple of things they could look at. So one is you can get started by investing into a fund. So essentially, you don't need to make your decision in terms of what you want to buy. And so there they have 2 or 3 options. One is you can invest into one of the Indian mutual funds that have foreign exposure. So Indian mutual funds are allowed to take about 35% exposure to the foreign markets. So that's the first way you can get started. The second is just purely invest into an index. So if you don't know which companies to invest in, how to start international investing, you can invest in essentially the equivalence of the Nifty 500 or the Sensex in the US. So the 2 indexes that are very popular, and as you pointed out, the NASDAQ 100 is one of the indexes, and the S&P 500 is another one, which Motilal Oswal recently launched an ETF for. The third way you can get started, again, if you just want to dip your toes into international investing, is you can invest into what they call as feeder funds. So they are basically funds that are set up in India that invest into other funds that are set up in the US. Now, these options are really great and each have their pros and cons. The last option, essentially, that is where we come in, is where we allow, in fact, investors to invest directly into the US markets. And so what we provide in terms of all of these new folks who are opening up brokerage accounts in the US is we provide them guidance. So we provide them portfolios that are available for somebody with different risk profiles. So if you're a conservative risk investor, you're an aggressive investor, you can pick these portfolios and get started in an easy manner. So there are lots of resources available for somebody to get started and take that first step towards international investing.
Okay, just before I move further, Viram, actually, I want to get one point clarified from you, and that's with respect to the laws that we currently have under foreign remittances. There is only a certain amount, and if you could just share that amount as well, I'm sure you would, be knowing that very well. There's only a certain amount that Indians can essentially remit. Now, would investing in, US mutual funds, feeder funds, or even in directly US equity stocks come under this foreign remittance limit? If you could just talk to us about that, and if you could just share what Indian laws say about that.
Definitely. So essentially what comes under the remittance limit is just a direct investing option. So if you're investing into through mutual funds or ETFs, you don't fall under the limit and you can invest how much ever you want. And that is the advantage of these funds to get started. It's a much easier way. Whereas if you want to directly invest, what you would do is you would actually convert your currency from INR to dollars. So you would be holding dollars in your brokerage account. And that's where the RBI regulation comes in, where the RBI has allowed an Indian resident to transfer up to $2.5 lakh every year abroad. And this money can be used for different purposes. So this can be used for education, travel, for maintenance of your relatives abroad. One of the purposes that is outlined and allowed by the RBI is investments into foreign equities. And so that's where your money that you're sending into your brokerage account comes in. And overall, whatever the total amount of money you send out, you can send out $2.5 lakh every year.
Okay, now that we've got that out of the way, like you mentioned, Viram, there are various ways one can invest in the US equity markets, mutual funds, index, ETFs basically. Motilal Oswal as well offered a fund, and then of course feeder funds and direct US investing. Now, direct US investing could get a little tricky for all of the reasons I cited above. So, who would you recommend uses the mutual fund route to invest in the US markets? I mean, even I'm just going to pull up that data which sort of showed me the sort of returns that some of these funds have given. This is of course taken from Morningstar, and in 2020 it's pretty decent. You have the Franklin India Feeder US Opportunities Fund, 15% return, the Motilal Oswal Nasdaq 100 ETF 15%, Nippon India, ICICI Prudential, all of them are in the positive. Though of course, mind you, individual stocks like an Amazon and Netflix have of course done really well, but they come, with its own set of risks. So, who would you recommend? What mode of investing? Which sort of an investor should go for, one of these US-oriented funds or foreign funds, as you could call them, and who should go for, direct investing?
With smaller amounts, it's definitely much better to go through the fund option because, as I mentioned, there is a conversion from INR to US dollars, right? And so there is a cost that is involved, which banks overlay on it, and that cost just becomes unviable, very unviable at a smaller amount. So somebody who wants to invest, say, larger sums of money, naturally, those are the people who should look at direct investing as well. The other thing to take into consideration when you're investing into these funds is that they essentially are high-risk funds. They are basically completely invested into equities, so they're tracking an underlying equity index. So if you are a conservative investor, international investing via these funds might not, especially the index funds, might not be the best option because you would be taking risk which is way beyond what you should be taking in your portfolio. And so there again, if you open a direct brokerage account, what happens is you get to essentially create a portfolio which is much more diversified. You don't need to just hold equities. You in fact get to hold essentially bonds or US treasuries, which are the safest assets in the world. and diversify your risk. So based on your risk also, you can decide whether which option is better. And lastly, it's the third parameter is essentially your goals, right? So if you want to say send your kids abroad for studying, or if you say have any particular goals in terms of saving a certain amount of dollars for travel, then it would be better essentially if you hold those dollars, right? Then you can directly use those dollars maybe to pay your child's fee abroad, or when you're traveling. So if you have those certain US dollar denominated goals, then again a direct option is better rather than investing into these funds which are more INR based.
That's actually quite, a sensible concept. If you have goals that do involve conversion to the US dollar, foreign currency, etc., then, Viram is recommending a US dollar based kitty as well that you could consider. Viram, just, a closing comment from you. We have the rupee depreciating quite significantly. I mean, the last time I checked, it had gone to almost 78, 79, though of course it has recuperated a tad bit. How would essentially US markets and investing in US markets also sort of diversify? I mean, if it would diversify against that risk, and additionally, for somebody who's perhaps creating a portfolio for retirement, or perhaps somebody who does not want to take on too much risk in their portfolio, should they still invest? Of course, not in direct stocks, but would you still recommend they add on these US funds in their portfolio?
Yeah, so on the first thing, essentially diversifying away from the rupee, I think that's a very, very good point. And that's one of the biggest reasons why somebody should invest internationally, is because you get to hedge against the currency. So you move away from having all your money in a single currency, because if you look at your portfolio, essentially over the last 10 years, it might have given you, say, 70, 80% returns. But on a global level, the rupee has actually depreciated about 40%. So if you convert your wealth into a global, sort of globally relevant wealth, then your returns are actually slashed by 40% immediately. And so that is where this discrepancy comes in, and you want to have some US dollar exposure to hedge against that. So basically, every time the rupee depreciates, and it has over the long run, over the last 10 years, about 40%, every time it depreciates, your portfolio value actually increases because the underlying investments are in US dollars. So whenever you're redeeming, you convert it back to INR, and hopefully the return rate is higher. So this is applicable, of course, over the long term, not over the short term. And on the second question, in terms of risk profile, I think the international markets have something for people of all kinds of risk profiles. That's where investing in funds doesn't give you that much flexibility, because most of the funds are essentially either investing into, say, the large cap stocks, which are the Apples, Googles of the world, or they're investing into indexes, which are inherently just equities or stocks, which are higher risk than, say, bonds or any other kind of assets, right? So which is why the direct option gives you much more flexibility in terms of creating a portfolio. For example, on platform, we have an all-weather investing portfolio, which basically invests across stocks, bonds, commodities, and gold. And so that is very much meant for somebody who wants to take much lesser risk than just investing all their money directly into stocks. And so that's where kind of the direct investment option is a benefit. However, if you want to get started with smaller amounts, then definitely the funds are the best way to get started and the most hassle-free way.
So basically, Vested is bringing the US markets to India, and it's doing so via an app. And of course, you could always, folks, you could always go on to this app and always connect with us as well on The Money Show. If you have any questions or queries on investing in the US equity markets, we'll be sure to bring on board Viram once again on The Money Show. But thanks so much, Viram, for so nicely explaining how the US markets are open to the Indian investors as well. They too can cash in on the opportunity that some of these technology stocks, some indices in the US have really thrown up. It's not only direct investing in US equity markets, but also some of these mutual funds that have US exposure that have really done very well. Okay, well, on to our next topic, which is, well, not such a positive, which is not throwing up such positive news.